Did you know that more than 90% of traders lose money in the financial markets? Most people enter trading with a simple dream: freedom. Freedom from a 9-to-5 job, freedom to work from anywhere, and freedom to make money with just a laptop and an internet connection. Social media makes it look easy. Screenshots of profits, luxury cars, beachside laptops, and overnight success stories flood Instagram, TikTok, and YouTube every single day. But behind this glamorous image lies a brutal reality that very few people talk about. According to multiple studies by brokers, exchanges, and financial regulators, nearly 90% of retail traders lose money over time. This is not an opinion, this is data. And today, we are going to break down exactly why this happens. Let's start with a hard fact. A study released by the U.S. Securities and Exchange Commission revealed that the majority of retail traders underperform the market, and a large percentage lose their entire trading capital within the first year. Similar reports from brokers in the United States and Europe show that only a small fraction of traders remain profitable after 12 months. Even more shocking is that many traders don't just lose money once, they keep depositing more funds, believing that the next trade will fix everything. This cycle repeats until their account reaches zero. One of the biggest reasons traders lose money is unrealistic expectations. Most beginners come into trading believing it is a fast way to get rich. They think a few winning trades can replace years of hard work. This belief is not accidental. It is carefully created by marketing, fake gurus, and highlight reels that show only wins and never losses. When a new trader expects to double their account every month, even normal losses feel like failure. This emotional pressure pushes them into making bad decisions.
Another major reason is the lack of proper education. Many traders start trading with only surface-level knowledge. They watch a few YouTube videos, learn a couple of indicators, and think they are ready to compete in the financial markets. But trading is not just clicking buy and sell buttons. It involves probability, risk management, psychology, market structure, and discipline. Without understanding these core concepts, traders are essentially gambling, not trading. Data from brokerage firms shows that traders who overtrade tend to lose the most money. Overtrading happens when traders take too many trades in a short period of time, often driven by boredom, fear of missing out, or the desire to recover losses quickly. Every trade comes with transaction costs, spreads, and commissions. When traders overtrade, these costs slowly eat away their capital, even if some trades are winners. Emotions play a massive role in trading losses. Fear and greed are the two strongest emotions in the market. When traders are afraid, they close winning trades too early. When they are greedy, they hold losing trades for too long. This behavior is backed by behavioral finance research, which shows that humans feel the pain of losses more strongly than the pleasure of gains. As a result, traders often break their own rules under emotional pressure. Another critical factor is poor risk management. Many traders risk too much on a single trade. They believe that higher risk means higher reward, but the data tells a different story. Professional traders focus on capital preservation first. Retail traders, on the other hand, often risk 10, 20, or even 50% of their account on one trade. One bad trade can wipe out weeks or months of progress. Two bad trades can end the entire journey. Leverage is another silent account killer. While leverage can increase profits, it also magnifies losses. In the United States, regulated brokers limit leverage for retail traders, but even then, many traders misuse it. They open positions that are far too large for their account size. A small market move against them triggers a margin call or a stop out, leaving them with heavy losses and emotional damage. Many traders also fail because they do not have a proven trading plan. They trade randomly, switching strategies every week. One day they follow indicators, the next day they trade support and resistance, and the next day they copy signals from a Telegram group. Without consistency, there is no way to measure what works and what doesn't. Data shows that traders who constantly change strategies never give themselves enough time to develop an edge. The myth of the perfect strategy is another trap. Beginners believe that somewhere out there is a secret strategy with a very high win rate. They spend months hopping from one system to another, chasing perfection. In reality, even professional traders have losing trades. The goal is not to avoid losses, but to manage them. Most profitable strategies have win rates between 40 and 60%. What matters is risk to reward, not perfection. Time is another underestimated factor. Many people trade while distracted. They trade during work hours, while watching TV, or late at night when they are tired. Trading requires focus and mental clarity. Studies in performance psychology show that decision-making quality drops significantly when a person is stressed or fatigued. Poor decisions lead to poor results. Another reason 90% of traders lose money is that they compare themselves to others. They see someone making big profits and feel pressured to do the same. This comparison leads to revenge trading, over-leveraging, and emotional mistakes. The market does not reward ego, it rewards discipline and patience. Lack of journaling is also a hidden problem. Most losing traders do not track their trades properly. They do not review their mistakes or analyze their performance. Without data, there is no improvement. Professional traders treat trading like a business. Every trade is recorded, reviewed, and learned from. Retail traders often treat it like a game. Finally, many traders quit too late or too early for the wrong reasons. Some quit after a few losses without giving themselves time to learn. Others continue trading even when they are clearly not prepared, burning money in the process. The data clearly shows that success in trading is not about intelligence or luck, it is about preparation, discipline, and realistic expectations.
To understand why 90% of traders lose money, we need to go deeper than charts and indicators. We need to understand the human brain. Trading is not just a technical activity, it is a psychological battlefield where emotions, instincts, and cognitive biases constantly influence decisions. Data from behavioral finance studies shows that most trading losses are not caused by bad strategies, but by poor emotional control. The human brain evolved for survival, not for financial markets. Thousands of years ago, quick reactions helped humans escape danger. In trading, these same instincts work against us. When price moves quickly, the brain releases stress hormones like cortisol and adrenaline. These chemicals reduce rational thinking and increase impulsive behavior. This is why traders panic during losses and become overconfident during wins. One of the most powerful psychological traps in trading is loss aversion. Research by Nobel Prize-winning economists Daniel Kahneman and Amos Tversky shows that people feel the pain of losing money about twice as strongly as the pleasure of gaining the same amount. In trading, this leads to a dangerous pattern. Traders close winning trades too early to lock in profits, but hold losing trades too long, hoping the market will turn around. Over time, this behavior destroys accounts. Another common psychological mistake is confirmation bias. Traders tend to look for information that supports their existing beliefs and ignore anything that contradicts them. If a trader believes the market will go up, they will focus on bullish signals and ignore bearish warnings. Data shows that confirmation bias leads traders to enter trades with weak setups and stay in bad trades longer than they should. Overconfidence is another silent killer. After a few winning trades, many traders start believing they have figured out the market. This leads to larger position sizes, higher risk, and less respect for stop losses. Studies from brokerage firms show that traders who experience early success are more likely to blow up their accounts later. Early wins create false confidence, not real skill. Fear of missing out, also known as FOMO, is heavily amplified by social media. When traders see others posting profits, they feel pressured to enter trades without proper analysis. They chase price after it has already moved, buying near the top or selling near the bottom. Market data shows that late entries usually have poor risk-to-reward ratios, making long-term profitability almost impossible. Revenge trading is another emotional response that causes massive losses. After a losing trade, many traders feel the urge to get their money back immediately. Instead of waiting for a high-quality setup, they take random trades with increased risk. This behavior is well documented in trading psychology studies and is one of the fastest ways to drain an account. The illusion of control is another psychological bias that affects traders. Many traders believe that by analyzing more indicators or watching the market more closely, they can control outcomes. In reality, markets are probabilistic. No trader can control individual trade outcomes. Professionals focus on controlling risk and executing their plan, not predicting every move. Another reason traders fail is emotional attachment to money. When traders risk money they cannot afford to lose, every price movement feels personal. This emotional attachment leads to stress, anxiety, and irrational decisions. Data shows that traders who trade with scared money perform significantly worse than those who trade with money they can emotionally detach from. The brain also struggles with randomness. Humans naturally look for patterns, even where none exist. In trading, this leads to seeing signals in random price movements. Traders convince themselves that a losing streak means a big win is coming, or that a winning streak will continue forever. Both beliefs are dangerous. Market outcomes are independent events, not emotional narratives. Another major psychological problem is impatience. Many traders expect results too quickly. They want consistent profits within weeks or months. When results don't meet expectations, frustration builds. This frustration leads to rule breaking, strategy hopping, and emotional decision making. Data from long-term trading studies show that consistency develops over years, not weeks. Ego also plays a destructive role in trading. Many traders want to be right, not profitable. They argue with the market instead of accepting losses. Professional traders understand that being wrong is part of the game. Retail traders often take losses as personal failures, which damages confidence and leads to emotional trading. The dopamine effect is another hidden danger. Dopamine is the chemical associated with reward and pleasure. Every winning trade releases dopamine in the brain, creating a sense of excitement. Over time, trading can become addictive. Traders start chasing the emotional high of winning rather than focusing on disciplined execution. This addiction-like behavior increases risk-taking and reduces long-term performance. Stress and fatigue also reduce trading performance. Studies in cognitive science show that mental fatigue lowers self-control and increases impulsive decisions. Traders who watch charts all day or trade without breaks are more likely to make mistakes. Professional traders schedule breaks, limit screen time, and protect their mental energy. Another psychological issue is lack of self-awareness. Many traders do not understand their own emotional triggers. They do not know what causes them to break rules or increase risk. Without self-awareness, the same mistakes repeat again and again. Data shows that traders who actively work on their psychology improve faster than those who focus only on technical analysis. Finally, most traders never train their mindset the way professionals do. Athletes, pilots, and surgeons all train under pressure. Traders rarely do. They jump straight into live markets without mental preparation. This lack of psychological training leaves them vulnerable to emotional reactions when real money is on the line. To truly understand why 90% of traders lose money, we need to stop guessing and start looking at real numbers. Not opinions, not motivation, actual broker data. Over the past decade, regulated brokers in the United States and Europe have been required to publish retail trader performance statistics. These reports reveal patterns that repeat again and again, regardless of market conditions. According to reports from U.S. regulated brokers, between 74% and 89% of retail trader accounts lose money over a 12-month period. In some years, especially during high volatility, that number crosses 90%. What is even more alarming is that the average losing trader does not just lose small amounts. Many lose a significant portion of their capital within the first few months. One detailed broker study showed that the average retail trader holds a position for less than 2 hours, yet believes they are investing or swing trading. This mismatch between belief and behavior leads to poor results. Short holding periods increase exposure to spreads, commissions, and random market noise. Data clearly shows that traders with extremely short holding times have the worst performance. Another shocking statistic comes from account survival rates. Data indicates that nearly 50% of new retail trading accounts hit a margin call or stop trading entirely within the first 90 days. By the end of 1 year, fewer than 20% of accounts remain active, and out of those remaining accounts, only a small fraction are profitable. This means most traders don't fail slowly, they fail fast. Leverage plays a massive role in this early failure. Broker data shows that accounts using higher leverage are far more likely to be wiped out. Even small market movements become fatal when position sizes are too large. Many traders believe leverage is the reason professionals make money. In reality, professionals use leverage carefully, while retail traders abuse it emotionally. Another consistent data point is poor entry timing. Studies show that retail traders tend to buy after price has already moved up and sell after price has already moved down. This behavior is driven by emotion, not analysis. Fear and excitement push traders to enter late, reducing their chances of success from the very beginning of each trade. Broker statistics also reveal that traders who trade more frequently lose more money. High-frequency retail traders pay more in spreads and commissions than they realize. Even if their win rate is close to 50%, transaction costs slowly drain their accounts. Over time, these small costs become massive losses. One U.S. brokerage study found that traders who placed fewer trades but focused on higher quality setups had significantly better performance. This confirms what professionals already know. Trading is not about activity, it is about selectivity. Most retail traders confuse being busy with being productive. Another important statistic involves stop-loss usage. Data shows that many losing traders either do not use stop losses at all or move them further away when price goes against them. This turns small losses into large ones. Profitable traders, on the other hand, accept small losses quickly and move on. This single habit creates a massive difference over time. The data also shows that traders underestimate drawdowns. Many traders quit or break rules after a small losing streak, even when their strategy is statistically valid. Professional traders expect drawdowns and plan for them. Retail traders take drawdowns personally and emotionally, which leads to impulsive decisions. Education level alone does not guarantee success. Broker data reveals that even traders who understand technical analysis can lose money if they lack discipline and risk control. Knowledge without execution is useless. The market does not reward intelligence, it rewards consistency. Another critical insight from data is that most traders do not track their performance correctly. Without accurate records, traders cannot identify what works and what doesn't. Profitable traders operate like analysts, reviewing performance metrics regularly. Losing traders operate on memory and emotion. One of the most uncomfortable truths revealed by data is that many traders are undercapitalized. Small accounts combined with unrealistic expectations push traders to take excessive risks. This creates a situation where 1 or 2 losses can end the entire journey. Professionals scale slowly. Retail traders rush. The final data-driven conclusion is simple, but brutal. Most traders are not failing because the market is unfair. They are failing because they approach trading with the wrong mindset, wrong expectations, and wrong behavior. The market is neutral. It does not care who wins or loses. Now here's the most important part. The goal of this video is not to discourage you, it is to wake you up. Because once you understand why 90% of traders lose money, you automatically separate yourself from the crowd. Awareness is the first edge. The traders who survive do not chase profits, they focus on survival. They protect their capital, they control risk, they respect probability. They understand that trading is a long-term performance game, not a shortcut to wealth. If you are willing to slow down, study the data, control your emotions, and treat trading like a business, you already place yourself ahead of most people, not because you were smarter, but because you were disciplined. The market does not reward hope, it rewards preparation. It does not reward excitement, it rewards patience. And it does not reward ego, it rewards humility. Most people will continue to lose money because they refuse to accept these truths, but a small percentage will listen, adapt, and improve. The question is simple. Which group will you choose to be in? 90% of traders lose money not because trading is impossible, but because most people refuse to change how they think, how they manage risk, and how they control their emotions. The data is clear. The patterns are proven. The outcome is predictable. Trading is not about winning every trade. It is about surviving long enough to let probability work in your favor. If this video helped you understand the real reasons behind trading losses, hit the like button so more traders can see the truth. Subscribe to the channel if you want data-driven, no-hype content that actually helps you grow. And remember, the goal is not to be right. The goal is to stay disciplined. The market will always be there tomorrow. Your capital won't be if you don't protect it.